I'm going to tell you something that will make every financial advisor in America want to strangle me. You've been lied to. The entire financial services industry has built a $1 trillion empire, convincing you that building wealth is complicated, that you need experts, that $100,000 isn't enough. They're wrong. And they know they're wrong. But if you knew how simple this actually is, they'd go out of business. So let me commit career suicide on their behalf and tell you the truth. With $100,000 and the discipline to do absolutely nothing for 30 years, you'll end up wealthier than 90% of Americans who are frantically trading, churning, and paying fees to people who can't beat a simple index fund. The number in your bank account doesn't make you wealthy. Your ability to leave it alone does. And that terrifies Wall Street. I'm Warren Buffett, and I've spent over 7 decades watching the financial services industry complicate something that should be simple just to justify their fees. I've seen fortunes created from nothing and fortunes evaporated through activity disguised as expertise. And the uncomfortable truth I've learned is this: most people don't have an income problem. They have a behavior problem. Give someone $100,000, and within 5 years, you'll see their true character. Not who they pretend to be at parties, but who they actually are when greed and fear start whispering. Before we begin, subscribe now, like this video, and leave a comment. That simple action helps more people see this content, and it tells me that sharing these lessons still matters. Now listen closely, because what I'm about to tell you will either change your financial life or make you angry enough to click away. Either way, you'll know the truth. The first principle: a dollar saved is more than a dollar earned. Here's the reality nobody wants to hear. Financial independence isn't about the size of your portfolio. It's about the size of your needs. I've known people living magnificently on $40,000 a year because they own their home outright and have no debt. And I've watched executives making $800,000 annually who are terrified because their lifestyle costs $900,000. The difference isn't income, it's sanity. When I bought my house in Omaha in 1958, I paid $31,500. I still live there today, not because I can't afford something bigger or fancier, but because that house serves its purpose. It's comfortable, it's paid for, and every dollar I didn't spend on a mansion has been compounding for over 60 years. That's the power of understanding opportunity cost. Most people think saving is about deprivation. It's not. It's about choosing what you value. Every unnecessary purchase isn't just money gone. It's decades of compounding gone. When you spend $50,000 on a car you don't need instead of a $20,000 car that serves the same purpose, you're not spending $30,000. At a 10% compound rate, you're spending $523,000 over 30 years. That's what that decision actually costs you. Let me break down the simple math that changes everything. Take $100,000. Invest it conservatively in a diversified portfolio of quality businesses through an index fund. Historically, you can expect around 10% annual returns over the long term. That's a doubling every 7 years. In 14 years, that $100,000 becomes $400,000. In 28 years, it's $1.6 million. In 42 years, it's $6.4 million. But here's where people destroy themselves. They can't leave it alone. They hear those numbers and think, that's too slow, I need to get rich faster. So they gamble, they chase tips, they day trade, they pour money into whatever's being hyped on social media, and they turn $100,000 into $50,000 faster than you can say compound interest. The tragedy is that $100,000 invested wisely is genuinely enough to build substantial wealth, but $100,000 invested foolishly is just an expensive lesson in what not to do. I didn't become wealthy by being the smartest investor. I became wealthy by being consistently rational and letting compounding do the heavy lifting. That's not genius. That's discipline. The second principle: know what you own and why you own it. People think investing is complicated. It's not. It's simple, but it's not easy. There's a massive difference. Simple means the rules are clear. Buy pieces of good businesses at reasonable prices and hold them. Not easy means following those rules requires fighting your own psychology every single day. Let me tell you about the biggest enemy of your $100,000. It's not market crashes. It's not inflation. It's not even taxes. It's you. Specifically, it's your need to do something. Americans are addicted to activity. We can't sit still. We think motion equals progress. In investing, activity usually equals wealth destruction. I've watched investors destroy their returns by constantly trading in and out of positions. They're trying to be clever, trying to time the market, trying to catch every move. Meanwhile, the investor who bought quality businesses and did nothing quietly compounded their way to wealth. The inability to sit on your hands is the most expensive personality trait in finance. Here's what $100,000 really represents. It's enough capital to let compounding work its magic. But compounding only works for people who can sit still long enough to let it happen. Most people can't. They interrupt the process every time they get nervous, bored, or envious. I've always said the stock market is a device for transferring money from the impatient to the patient. Let me give you the framework I've used for decades that works just as well with $100,000 as it does with billions. Invest in businesses you understand, not businesses that sound impressive, not businesses your neighbor is excited about, businesses where you actually comprehend how they make money, what their competitive advantages are, and why they'll still be relevant in 10 years. When I bought Coca-Cola, I didn't need complex financial models. I understood that people around the world love this product and will continue buying it for decades. Simple. When I bought See's candies, I understood that people give boxes of candy as gifts and have done so for generations. Simple. When I invested in insurance companies, I understood the business model. Collect premiums now, pay claims later, invest the float in between. Simple. This isn't unsophisticated analysis. It's sophisticated simplicity. There's a massive difference. If you can't explain your investment thesis to a 10-year-old in 2 minutes, you don't understand it well enough to own it. And if you don't understand it, you'll panic and sell at the worst possible time. The third principle: price is what you pay, value is what you get. Here's how I'd allocate $100,000 today if I were starting over. And I mean this literally, not as theory, but as practical guidance. I'd put $90,000 into a low-cost S&P 500 index fund. Not because it's exciting, not because it'll make impressive cocktail party conversation, but because it works. An S&P 500 index fund gives you ownership in 500 of America's best businesses. You're not betting on individual companies. You're betting on American capitalism, which has worked pretty well for over 2 centuries. The fees are minimal, maybe 0.03 cent to 0.04% annually. That means almost all your returns stay in your pocket instead of going to some fund manager. The remaining $10,000 stays in cash, short-term treasury bills. This is your sleep at night money. This is what keeps you from panicking and selling everything when the market drops 30%. And it will drop 30% at some point. Markets always do. Having cash on hand gives you the emotional stability to hold through downturns and the flexibility to buy more when everyone else is terrified. That's it. No exotic derivatives, no cryptocurrency gambling, no hot stock tips, just boring, proven wealth-building strategy. But here's what will actually happen with most people's $100,000. They'll ignore this advice. They'll keep $10,000 in index funds. Then they'll put $40,000 into whatever their coworker is talking about. Another $30,000 chasing whatever CNBC is hyping. And $20,000 day trading because it feels like they're actively managing their wealth. 5 years later, they'll have $60,000 left and a story about how the market is rigged against the little guy. The market isn't rigged. Their behavior is broken. I've been saying this for decades. The key to investing is not losing money. Rule number 1, never lose money. Rule number 2, never forget rule number 1. But you can't avoid losses if you don't understand what you own. When you own a broad index of American businesses, you can hold through downturns because you understand that capitalism works over time. When you own whatever was trending on Twitter last week, you'll panic sell the moment it drops because you have no conviction, no understanding, no thesis, just hope. The fourth principle: time is the friend of the wonderful business. This is where most investors sabotage themselves. They treat their $100,000 like lottery tickets instead of seeds in a garden. They want immediate, massive returns. They want to turn $100,000 into $1 million in 2 years. That mentality destroys more wealth than any market crash ever could. A garden grows slowly. You plant quality seeds in good soil. You water them consistently. You protect them from pests. You don't dig them up every week to check if they're growing. And over time, with patience and proper care, you get a harvest that can sustain you for years. That's how wealth works. But people want magic beans. They want to plant today and harvest tomorrow. So they gamble on penny stocks. They chase meme stocks. They pour money into speculative nonsense they don't understand, and they kill their financial future before it ever has a chance to grow. The compounding on $100,000 over 30 years at 10% turns it into $1.74 million. That's not theory, that's arithmetic. But it requires you to not be stupid for 3 decades. And apparently, that's too difficult for most people. They can manage rationality for a year, maybe 2. Then they read about someone who made 500% on some trade and envy destroys them. They abandon their plan, they chase excitement, and they restart their wealth-building journey at 0. I've always told investors, you don't have to swing at every pitch. In investing, you can watch 1,000 pitches go by and wait for the perfect one. Nobody's going to call you out for being patient, but people can't help themselves. They confuse patience with passivity. They think sitting still means missing opportunities. They're wrong. Patience is the most active thing you can do in investing. Patience is saying no to bad opportunities so you can say yes to great ones. With $100,000, you don't need great opportunities every week. You need one great opportunity, buying a low-cost index fund, and they need to leave it alone for decades. The 5th principle. Lifestyle is the enemy of wealth. Here's the part nobody wants to hear. Your lifestyle determines whether $100,000 is enough or not. If you live like you make $200,000 a year, then $100,000 in savings is just a speed bump on your road to financial stress. But if you live on $40,000 a year, that $100,000 is the foundation of genuine financial independence. The math is straightforward. The average American household spends roughly $70,000 per year. If you can live comfortably on $40,000, which millions of Americans do, your $100,000 generating 10% gives you $10,000 annually. That's not enough to retire on immediately, but reinvested and compounded, it grows. $100,000 becomes $110,000, then $121,000, then $133,100. The snowball builds. But only if you stop treating your investment account like an ATM. I've watched people destroy 6-figure portfolios by taking small withdrawals. $5,000 here for a vacation, $10,000 there for a new car, $15,000 for home renovations they didn't really need. They think they're just accessing their money. What they're actually doing is killing the goose that could have laid golden eggs for the rest of their life. Every dollar you withdraw is a dollar that can't compound. Over 20 or 30 years, that single dollar could have become $5 or $10. So when you withdraw $10,000 for something you don't truly need, you're not spending $10,000. You're spending the $50,000 or $100,000 it could have become. Most people never think about wealth this way. They think in terms of account balances, not future value. They think in terms of what they can afford now, not what they're giving up later. That's why they stay middle class even when they earn good incomes. The 6th principle. Avoid debt like the plague. Let me address the elephant in the room. What if you're starting with less than $100,000? What if you're at $50,000 or $30,000 or just $10,000? The principles don't change. In fact, they become more important. With less capital, you have less room for error. That means you need even more discipline, even more patience, even more focus on avoiding stupidity. The beautiful thing about compounding is it doesn't discriminate based on starting amount. It works the same on $10,000 as it does on $10 billion. The percentages are identical. The only difference is time and behavior. If you're at $50,000 and you invest wisely, live below your means, and avoid catastrophic mistakes, you'll reach $100,000, then $200,000, then more. The question isn't whether the math works. The question is whether you'll let it. Most people won't. They'll get impatient. They'll take unnecessary risks. They'll compare themselves to people who got lucky or who are lying on social media about their returns, and they'll sabotage their own progress. I've said this for decades, but it bears repeating. In investing, temperament matters more than intelligence. I've seen people with average IQs build substantial wealth through discipline and patience. And I've watched genuinely brilliant people destroy themselves through arrogance and impulsivity. Your $100,000 doesn't care how smart you are. It only cares how disciplined you are. Here's another uncomfortable truth. Most financial advice is designed to make the advisor wealthy, not you. Complexity benefits the person selling it. When someone tries to sell you structured products, alternative investments, or strategies that require a PhD to understand, run away. They're not trying to help you. They're trying to generate fees. My strategy can be explained to a child. Buy a low-cost index fund of quality American businesses and hold it forever. That's it. No fancy derivatives, no complex hedging, no active management, just common sense applied consistently. If you can't explain your investment strategy in one sentence, you probably don't have a strategy. You have hope dressed up as sophistication. And hope is not an investment plan. The financial services industry has convinced people that investing requires experts, constant monitoring, and active management. It doesn't. For most people with $100,000, the winning strategy is buying an S&P 500 index fund and ignoring it for decades. But that advice doesn't generate fees for advisors. It doesn't create the illusion of value-added services. So instead, they sell you churning, trading, rebalancing, and 1,000 other activities designed to make you feel like something important is happening. Usually, the most important thing that could happen is nothing. The seventh principle: know what game you're playing. Let me give you a final framework for thinking about your $100,000. Understand what phase of wealth building you're in. If you're young, under 40, you're in accumulation mode. This is where time is your greatest asset. Invest aggressively in stocks. Live below your means. Save as much as you can. Let compounding work for decades. If you're approaching retirement, 50 to 65, you're transitioning into preservation mode. You still need growth, but you can't afford catastrophic losses. Start shifting some allocation toward bonds or cash. Reduce risk gradually as you get closer to needing the money. If you're in retirement, over 65, you're in distribution mode. You need income and stability. Your focus shifts from growth to preservation and income generation. The mistake people make is using the wrong strategy for their phase. A 25-year-old investing like a 65-year-old is wasting their greatest asset, time. A 65-year-old investing like a 25-year-old is gambling with money they can't afford to lose. But here's what never changes regardless of age: the need to avoid stupidity. At 25, stupidity looks like day trading your entire account. At 65, stupidity looks like chasing high yields in junk bonds because you need income. The specifics change with age. The underlying principle doesn't. People always ask me, Warren, what's the secret to getting rich? There isn't one. The real secret is simpler. Don't get poor. Don't blow up your account. Don't make unrecoverable mistakes. Don't let greed, fear, or ego control your decisions. That's not exciting advice. It won't get you clicks on social media. But it's the truth. Wealth building is more about avoiding disasters than achieving brilliance. Your $100,000 is enough. It's more than enough if you're willing to be patient, disciplined, and rational. But it will never feel like enough if you keep comparing yourself to others, inflating your lifestyle, or chasing the next big thing. The person who knows enough can't be manipulated by promises of more. That's real wealth. Not the number in your account, but the peace in your mind. I've spent 7 decades proving that ordinary people can build extraordinary wealth by investing in quality businesses, living below their means, and letting time work its magic. That strategy works with $100,000 just as well as it worked with billions. The question isn't whether it works. The question is whether you'll let it. whether you'll fight your own worst impulses long enough for mathematics to work its magic. Because here's the final truth. Compounding doesn't require genius. It requires time and discipline. Give it both, and $100,000 becomes the foundation of financial independence. Deny it either, and $100,000 becomes just another story about money you used to have. The choice is yours. The math doesn't care about your feelings. It only rewards your behavior. Choose wisely. If these words resonated with you, it means you're serious about building wealth the right way. Subscribe now, like this video, and leave a comment. That simple action helps more people find this content, and it tells me that sharing these lessons still matters.